Hello and welcome to the 9th episode of the Dogs of the Wall Street podcast, and today we're here to explain and discuss the rise of GameStop in the past week. I'm sure a lot of you have heard about the recent surge in the price of GameStop stock, ticker GME. We're here to explain what exactly the reasons were behind the surge, what triggered the surge, and the state of GameStop before the surge, and why so many brokerages like Robin, clearing firms, and hedge funds like Citadel are under the spotlight. To start, let's talk about the state of GameStop before the whole surge. GameStop could be considered a modern-day blockbuster. You could say it had its heyday back in 2007. A company that rents out physical game discs is quickly being overtaken by just downloading games online, and so every day there is less of a reason to go out and buy a physical copy of a game. We all know what happened to Blockbuster. It got taken over by Netflix and had to shut down operations. The same thing could be said to almost be happening to GameStop. For this reason, many big institutional investors and hedge funds saw the opportunity to capitalize on the fall of GameStop by opening what are called short positions.
Now, for those of you who don't know, a short position allows you to basically make money when a stock goes down, which is kind of strange because most people are accustomed to, buying a long position or making money when the price of the stock goes up. Well, the way that hedge funds are able to do this is that they're able to borrow stock and return it and pocket the difference in price between borrowing it and returning it. So, to give an example, right? Let's say...
So wait, let's just break this down for a second, right? So normal investing, what you do is you buy low and then you sell high, right? And this is just reversing the process. So you sell high and then you buy low, right?
Right.
And the way that these hedge funds can actually borrow the stocks is from brokerages or from like existing portfolios. So they don't buy it from the open market because that doesn't really make any sense because you can't borrow from the open market. They borrow from existing portfolios, right? So they basically do it through private transaction generally, or they what you would do when you're shorting is you would take on margin and then buy it from the open market and then sell it, right? And then you would pocket the money, and once you actually cover the short, which Mahesh, I'll let you explain it. That's when the entire transaction, I guess, ends, and that's how you profit off of it.
Yeah. So to draw an analogy in the example of borrowing a car, let's say that I borrow a car that's worth $50,000 at the time of borrowing. And I have to promise this person that I'll return the car after 1 year of passing, or how many years of passing. So I gotta return the car to him eventually. So what I can do to make a profit out of this is I immediately sell the car after borrowing it on the open market. And so now I have $50,000 in cash. And so after this, let's say after the year when I have to return the car back to the lender, it's only worth $10,000. So I can purchase this car for $10,000 and pocket the $40,000 difference and just return the car back to the lender, which was the original promise. And now I've made a profit out of basically selling high and buying low. Exactly what Ruvich said before. So this is essentially what happens when you open a short position, except instead of borrowing a car, you do the same thing with shares. And an important thing to note, which will come up later, is that they'll always have interest fees with a short position. So, you're borrowing an asset, so it makes sense that you should pay interest on it. You borrow a loan, you pay interest on the loan. So investors also have to pay interest when opening a short position, and that'll come up as important.
Right. And obviously the reason you have to pay interest is because of the time value of money. It takes an amount of time for prices to move. And obviously the shorter the amount of movement is like the better your profit, right? Because you have to pay less in interest total.
And obviously without
generally
interest,
you'll see people. Right, exactly. Well, that's why you'll generally see investors open short positions whenever a stock is like very volatile, because that'll sort of like calm down the market essentially, right? With more sellers than buyers. And what happens then is within a shorter amount of time, the price begins to decrease instead of within an extended period of time where they'd have to pay more in interest fees.
So how does this shorting scenario apply to GameStop exactly? Well, GameStop was actually one of the most heavily shorted stocks on the market, with actually 140% of the shares in existence being short at its peak. These short positions were all taken on by large hedge funds, hoping to take advantage of the fall of GameStop due to the pandemic. Now, you might be wondering, how can more shares be short than actually exist? Well, truthfully, it shouldn't really be allowed, but here's the concept. Fund A opens a short position on GME. Fund A then lets Fund B borrow the shares, so now Fund B has a short position. So now more shares are on the hook, 2 shares are owed. In this manner, more shares were short than existed, since either a clearing firm, market maker, or broker loaned shares which didn't exist, which will come up later.
Now, what specifically contributed to the meteoric rise of GME, which is the ticker for GameStop that we saw in the past week, was both a combination of what's called a short squeeze and a gamma squeeze. So I'll start by talking about what a short squeeze is. But before that, let's talk about what actually triggered the short squeeze, which is a series of events that happened to GameStop, which actually raised consumer sentiment. So to start off, person known as Reggie Fils-Aimé was actually brought onto the board of directors in March of 2020, who was the same person that helped Nintendo America escape bankruptcy in the late 90s and early 2000s. So that was one reason why GameStop actually saw a tiny increase in price. And then second, co-founder of Chewy.com, Ryan Cohen, bought 10% of all GameStop shares, later increasing his position to 12.9% with the goal of transforming GameStop into a more online modern company. And so, of course, Ryan Cohen is the co-founder of Chewy.com, must be a e-commerce, king. So it makes sense that he could help the company transform into the whole modern e-commerce landscape. And third is the release of both the Xbox X and the PS5 that we saw in Christmas of 2020, and that drove piles of gamers, of course, to GameStop to purchase games for their new consoles. So seeing all this
that's
good
more of a
news,
recent event.
right? Yeah,
but
event,
another thing that led to the buildup was, as you mentioned, the leadership change. That was the primary reason for all of this, and it actually led to more institutions coming in. And obviously, there was somewhat of a rift depending on what the institution was. So, for example, Scion Capital Management, which is run by Michael Burry, who actually he's historically known for being a bear, or at least a very value-oriented investor.
Yeah.
He shorted the housing market in 2008, and that's how he sort of rose to notoriety. He's a very interesting character, by the way. If you're more interested in markets, you should watch The Big Short. But he actually brought into GameStop because he believed in their model and their leadership, and I'm pretty sure he bought when it was around $3 a share, surprisingly. So and even more ironic is the fact that when GameStop saw this meteoric rise in the past couple of days, he asked the SEC to investigate it. So yeah, maybe he sold early or something.
Yep. So the change in leadership was the primary reason, but sort of a combination of these and other reasons saw traders actually starting to buy shares of GME again, although hedge funds just kept increasing their short positions. Eventually, a single post on the Reddit forum known as Wall Street Bets would be the final straw that broke the camel's back, which highlighted the massive short positions taken on GameStop and saw an opportunity to trigger what's called a short squeeze. So when hordes of retail investors started buying shares of GameStop for all of the reasons that we previously talked about, hedge funds had to eventually start closing out their positions, which meant they were buying back shares at a loss. Another factor for closing out their positions was the previously mentioned interest payments on their positions, which actually were ridiculously high considering the large amount of institutions shorting this specific stock, which was GameStop, right? So I'm not sure about the exact number, but I think it was almost 40% or something ridiculous like that, because so many people were shorting GameStop that, of course, brokerages saw an opportunity to capitalize on it. So this meant that time was not on their side. So it just added to the flame in order to get these hedge funds to close out their positions. So, of course, in order to close out their positions, these short sellers needed to buy back the stock. And so this drove up the price even further. And so in this way, more hedge funds closed out their positions, which drove up the stock price. And then that led even more hedge funds to close out the positions. So this vicious cycle continued, and that was the main cause of the meteoric rise that we saw in GameStop in the past week, and this is what's called the short squeeze. Now, another factor which contributed to the rise, which is not as important, but still served a role, which is called a gamma squeeze. Now, essentially what a gamma squeeze is, by definition, is when market makers hedge their positions by buying more stock when they are down on the call options they write or sell. So obviously that might not have made sense to a lot of you, so let me explain with an example, right? So call options are contracts which give their buyer the option to purchase 100 shares of a stock, typically 100, at a particular strike price before some expiration date. So for example, if I buy a call option on GME with a strike price of $12 and it's currently trading at 10, I have the right to buy 100 shares of GameStop at $12. So in this way, if GME goes even to $15 a share, I make 15 minus 12, the difference in profit on each share times the 100 shares that the contract controls, which is $300 in profit. Now, as you might know, whenever a trade is made on the stock market, I mean, there's a transfer of money. So if someone gains, there's a person who loses. So if I profit on my call option, someone has to provide me those 100 shares of GameStop at the strike price, regardless of what the current market price is, right? Or in our example, it would be at $12 each. So typically the people who provide these are the people who sold the call. People who write options are called market makers. And so they're the ones who write the call options so that investors could buy them. And so typically when they saw this meteoric rise in GameStop, they hedged the calls that they wrote or sold. So they minimized their risk by buying more shares of the underlying stock, in this case, GameStop. So they did this because even if GameStop kept going up, they would lose money on the call options that they sold, but they would make money on the underlying shares that they bought, which would minimize their risk. And so what happens when you buy more shares? Well, it raises the demand, it raises the price. So that was a secondary reason that led to the increase of price in GameStop, which is called the gamma squeeze. So these are the two big reasons why this meteoric price surge happened to GameStop, both the short squeeze and the gamma squeeze. So now we'll get into the controversy that Robinhood has been facing regarding their actions during the past week. So Raghav, you can take care of that.
So the stock brokerage app, as you all know, Robinhood, it's very common with retail investors who are stuck at home during the pandemic, want something else to do. And what it did is basically after the GameStop price drove up heavily, it restricted trading for a lot of, like, all investors. So what it basically did was only allowed current holders to close out their positions in GME and was not allowing them to buy more shares. And if you were a new investor, obviously you couldn't buy more shares of GME at all. And this brought up the question of restricting a free and fair market. And effectively, this move basically helped hedge funds cover their losses a bit because the GME stock price fell down almost 30% the day it restricted trading. And it was hit with Robinhood was hit with many class action lawsuits and scorn from all sides of the floor. And the news just came in that the Robinhood CEO, I think his name is Vladimir Tenev, is going to testify before Congress. So the issue is still ongoing. I don't know if they will face consequences for these, but do you guys think they should face consequences for their actions?
In terms of restricting traders, I believe that there may be some legal basis. Also because Robinhood was automatically selling some of the GameStop holdings in their investors' portfolios. So that's, again, there's definitely some cause for legal actions that's happened in some individual situations, and there's obviously probably a good amount of stuff that's left to be uncovered because there's Robinhood like high level management people who said that people from the government tried calling them, and people from Citadel and other institutions told them, like, hey, you need to handle this, right? Nothing specific has come out to really signify that could be corruption. But if there's more of an investigation done on it, which I don't think is going to happen just because of the clandestine nature of the markets, you may be able to uncover something, right? So the real question isn't like, should something happen in terms of legal action, because most likely nothing will, right? Like, if we're being realistic. But what could happen is a lot of the investors could be having an exodus from the app. And I've heard a lot of people are like uninstalling it and transferring to other brokers now.
So on the topic of if Robinhood should face legal action, I think a lot of people are quick to assume that what Robinhood did was in the best interest of one of their clients, Citadel, which could be the case. But there's another thing to be said, which is that a lot of these clearing firms and brokerages were actually in the middle, almost on the verge of a liquidity crisis, which is that there were so many shares that were being sold short and so many shares being held up in relentless retail traders that if there was an event where all of the short positions were to be closed at one time, there wouldn't have been actually enough capital to close out the positions and not enough shares, which would have to be provided by mostly these the Wall Street Bets investors. So that if that were the case, then the entire market wouldn't have enough liquidity in existence, and that's obviously a really big problem. So seconds away from triggering a nuclear bomb, in my opinion, they had to shut down operations, because if not, they run the risk of being caught on the hook for delivering shares, um, which if you don't have is going to be difficult. Now, if
Yeah.
what they did was the best course of action, I'm not sure. They could have, raised margin requirements or interest payments or something, which would have received, a similar effect. But there certainly were more conditions to take into account. So yeah.
Right. Well, a lot of this is at the discretion of the
Right.
brokerages, but
So-
the thing is, people want to say like, oh yeah, Citadel is 100% responsible for all of the losses that they're making, and they should probably just man up and take it, right? They don't really understand like how much money is tied up in these hedge funds and like what type of issues it could lead to. So again, I think on some level these rather amateur investors are probably being arrogant and selfish in terms of like, oh, why is Robinhood doing this? Like they don't really see the macroeconomic impacts of it, right? And obviously, this has led to some discussion saying that like short selling shouldn't even happen because it's like negative for the economy. All it does is hurt other people, which I frankly, I don't really agree with that statement. I think short selling really contributes to the accuracy and efficiency of prices. And without the transparency of like what everyone's opinion is in a market, it can't really be efficient, right? So with only having half of the argument heard or like having half of the side participate, which is the bulls, there's no balancing act. So if you just had that, then what you would have is you'd have constantly bullish cycles, and then up until a point of a recession where there wouldn't be anyone to really help realize that. So then the Fed would just have to do quantitative easing again, right? So it's kind of like one of those special situations, but it happens more often than not. And I think that would be terrible for obviously the central bank, the Federal Reserve. It'd probably cause a lot of inflation as well in terms of assets, and probably it would trickle down to currency eventually. So I think short selling as a mechanism itself, there's nothing wrong with it. And it can also be good for investors too, right? Because if short selling pushes the price down, if you're a value investor, that may actually be a good point for you to buy in. So, not everyone wants to purchase at the market price. You can find a stock that's being shorted heavily, and then hopefully you'll get like a discount on it, right? So, that's like, there's several reasons for having short selling exist. I don't think banning short selling is going to do anything like in terms of helping the market. It's probably just going to make them less liquid. And if anything, they're not going to be as efficient.
Right. Yeah.
Yeah, like again, like I don't know, the logistics of banning short selling would be really hard because after all, short selling is just a product of economic
Right.
forces, right? Prices
Yeah.
go up, prices
It
go
just
down.
reflected the
It's just
security's
that
underlying
when prices
fundamentals.
go
If you're
down,
looking since 2018 on their financial statements, GameStop, it kind of looked flatlining, and if anything, they're operating at like negative EBITDA since 2019. So, and I assume that's when the big short positions started opening, right? So, and before that, it was quite overpriced just because of like the nature of like gaming at that point. Activision and all of those other companies were going up. So, along with that, GameStop took a ride. Like they hitched a ride with Activision, right? Which is a software company. And GameStop is a low margin retailer. So, and I don't think anybody buys games in person anymore anyways, right? They buy them from their console or they buy them on the PC. So the business model seriously wasn't working out. If anything, it was just a retailer. And at this point, retailers weren't doing that well anyways, especially not specialized ones, right? So it was a great market signal. I don't think it was a bad decision to short sell. And you can't really blame the investors here either. It's just a very interesting situation to monitor.
right, right. So, as you know, these hedge funds suffered massive losses. Melvin Capital actually lost more than 53% because of GameStop short squeeze. So, do you think these hedge funds will recover from their losses, or do you believe some will go bankrupt?
They're gonna surely recover. I mean, based on the action we've seen from brokerages to make sure that we don't have massive crises, we'll see them recover. Although they have taken obviously big hits, I don't think any of them are going to be forced to go under.
Yeah, I don't think any one of them have been hit so hard that they'll actually have to just stop existing. Historically, they've been bailed out, so I don't think it's the end for hedge funds that even have been hit really hard.
I mean, yeah, essentially Robinhood's move on restricting GameStop trading was kind of bailing them out, right? So I think that's why the general consensus among retail investors was, hey, you're letting the big guys win. What about us? Do you believe there should be any regulation in terms of like short squeezing and all this stuff? Like, the SEC intervening in this matter?
Well, I mean, this is really based on personal opinion. And my personal opinion relies on the fact that like I don't really like regulation on financial markets as much, because a lot of the time it does more harm than good. But the thing is with a situation like this, it's super hard to like understand what side is right and what side is wrong, right? So I've actually seen politicians on opposite sides uniting and favoring Main Street over Wall Street, as they like to say. But like,
True, yeah.
I don't think people understand that Wall Street has all of your money, guys. It's not Main Street versus Wall Street. We're all supposed to be on the same street. So, you know, having it said in that like sort of diverging phrasing, I don't think that does us any good. Yeah, and if I'm being honest, like it would be smarter for retail investors to just like take their money and go, because at this point there's no like there has to be an upper limit somewhere, right? Like they can't just keep sitting and holding the stock and hope that it goes up, because there's no underlying to it. So and if you're a value investor like me, and not just like a trader who thinks like, you know, I can swing a couple of $1,000 in a couple of days, what I personally believe is all of the value of a stock is from its underlying cash flows, and GameStop is operating at negative cash flow. Therefore, why would I own it? Right?
Yeah, I'm gonna have to agree with
I think-
Rudvich on this one. I really don't want this, again, personal opinion. I don't want the government regulating any of this, because the government is controlled by the people, at least in theory. Not gonna go into that. And the people don't really know about the intricacies of the economy and how Wall Street affects our everyday lives. They don't know that doing something on Wall Street is ultimately gonna end up on our desk. That's why I don't want the government intervening in any of this.
Right. So the quote unquote corruption that's happening between Robinhood and Citadel, there you can't really regulate that, is what I'm saying, right? And Wall Street is powerful enough to sort of, you know, cool down this rally. And if they believe that like that's the right decision to make at this point, then I feel like we should generally like err on the side of them. Because considering how complex the financial system is, we should be surprised to wake up every morning with all of our money in our bank accounts, right? Like, because considering how intricate banks are, the fact that they're able to manage it like very consistently for the most part, that's something to be proud of, right? And something to really, I mean, if you're trusting your own money within these banks, I'd say you should trust, especially the hedge funds and the big financial institutions, who essentially they want the best for themselves, but the best for themselves comes from the best for us. So yeah,
Because the best for us is what gives them the money. Otherwise, they don't.
exactly. I mean, without us, there's no money, right?
Ultimately, yeah,
I think the big question that
it doesn't require a lot of regulation because this rarely happens, at least in these large scales. We'll see, like, you know, a few short squeezes a year, but
Right.
nothing this big that often. So it's really important that the market functions how it's supposed to, which is that, of course, this is traditional economic theory. People act rationally. They wouldn't buy anything that has a negative cash flow. They wouldn't pump up the price to like 18, 20 times.
I think the big question that decides whether the SEC should intervene, and what most people are asking is this what happened considered market manipulation? And obviously that's a super difficult question to answer, and it largely comes down to personal opinion. But by definition, right? Yes, it is. Like Wall Street bets coming together and colluding to jump in on a stock is market manipulation. But the common counter argument to that is Wall Street hedge funds have been doing the same thing for decades now. They're with their large capital influence are just able to pump and dump stocks and largely manipulate the market in the same way that Wall Street bets could. So if the SEC were to intervene in what's happening from Wall Street bets right now, why haven't they intervened in the questionable actions of hedge funds, who are almost responsible for the collapse of the entire economy in 2008? So it's kind of like it's difficult in that sense to really take a stance one way or another to consider who
Right.
should be penalized.
Yeah, because
Yeah,
on the
I agree.
opposite end, like what I've been saying is that what the traders are doing now is leading to an economic like pricing error, right? Because it's inefficient in terms of the information that's represented in the market. But then other people, like very progressive investors such as Chamath Palihapitiya, he's come out and said like, oh yeah, well this is behavioral economics, right? Like forget about traditional theory or whatever, and forget about finance. He's saying like if this is the demand of the stock, then it's a free market, right? So like it has to be upheld in this sense. But at the same time, it doesn't follow like any of the tenets of economic theory, other than the fact that like this is sort of an artificial demand, if anything.
Yep.
It's not sustained by any information other than, make it moon, make it go up, right? Like it's just sustained by the fact that we want to manipulate the price to make more money. So that's not really any sort of efficient information to operate on. I think it's good for retail traders to make money off of this. It's not necessarily a bad thing for them to do that, I guess. But considering this as investing or some sort of level of financial genius, it really isn't.
I mean, I agree that we should take into account behavioral economics, but we shouldn't go so far away from traditional economics that the markets are gonna start acting so volatile you can't really invest in a good way. Like if you base everything on behavioral economics, it's gonna make the markets a lot more volatile. The stock market, people's savings, pension funds, everything's gonna be much more uncertain than with a more concrete economic theory. That's why I think the best course of action right now would just be to crack down on market manipulation, whether it's on, quote unquote Main Street or on Wall Street.
Right. And we saw, besides for GameStop, we obviously saw some other notable stocks, mainly AMC and Nokia's stocks.
I believe Nokia wasn't a short squeeze. It was just market manipulation, straightforward.
Right, yeah. A lot of the side effects weren't actually short squeezes, just people realizing that, if we can do it to one, thing, we can do it to, everything else, so.
They're applying the same logic to a bunch of low market cap stocks, which again, it happens on like penny stock forums all the time. And that's sort of hard to catch because, again, the stocks are very low market cap. So it's a very rare to see like this level of manipulation on like actual large market cap stocks that are, part of like indexes or parts of mutual funds, like, stocks that actually have some sort of ramifications in terms of the economy. Like you see it with small penny stocks very frequently, but just on this level, it's kind of rare.
So my last question is, do you believe this will set the precedent for a lot more retail investor fueled short squeezes now that, stock trading is more popular and, people know how to manipulate the market?
Definitely not. At least in my opinion. This is a really high profile case, right? Obviously, we saw all the brokerages, all companies involved within a few days, and even the federal government involved within a few days of the occurrence. I think this will actually lead to some government interference. I mean, some kind of regulation that'll prevent something like this from ever happening again. While it does set a precedent for political change, it's not gonna like actually make a precedent for repeated occurrences of this.
I think it also comes down to the fact that the world has experienced this once, so they're all prepared. Like hedge funds, I don't think they see this as a big threat, but maybe to some extent are prepared for something like this to happen in the future. Or mainly it's that regulation has changed in response to this, which is the real precedent. Maybe this would set the precedent for more just straight up market manipulation from groups of retail investors, which has already happened with stocks like, BB, Nokia, Bed Bath & Beyond, and so many others. But that's what I think.
Yeah. Well, we may not know it. Hedge funds know that they're pretty much the backbone of the economy. These large funds with big pools of money are holding up the economy. The rich people know that. The politicians know that. The only people that need to catch on is Main Street.
Yeah. These retail investors, like people.
Right. Main Street keeps on asking, like people in the sort of retail subreddits and that type of thing. They keep on asking, like, oh, if Wall Street can gamble all their money, why can't we do it? Like, the reason Wall Street does it is because it serves a far larger purpose than what you're doing it for, right? Like, they only make a very, very small chunk of commission on all these amazing trades that they're doing, supposedly, right? Like, in terms of percentage returns, the retail investor is making asymmetrically way more than what the hedge fund manager is making, doing far more research and far more due diligence in terms of his actions. So, sure, he's quote-unquote gambling, but, like, his returns aren't like anything that's too amazing. Like I've seen these retail traders make more than these hedge fund managers may make in the next 10 years, right? Like in terms of like percentage returns, right?
Right, yeah, percentage. Yeah.
Yeah, I wouldn't exactly use the
So-
word
so-
gambling with these hedge fund managers, so that implies that you don't really know exactly what you're doing. This is more like an educated,
Mhm.
big risk that they're taking.
Right.
Whereas what we see
Right,
with the
right.
retail
Educated
investors
risks
is
need to be
they
taken.
listen to advice that they see on Reddit and then they
Right.
do that. That's not
And
really...
I'm not a shill for institutions in any sense of the word, but I just believe that like when Main Street starts doing it, like even if you think that what the hedge funds were doing is wrong, two wrongs don't make a right, right? So why are you doing it? It's entirely for personal profit. So yeah.
In conclusion, based on the events of the past week at the Dogs of Wall Street, we think that while these events may lead to some political change, maybe some increased regulation on market manipulation, we don't think this is ever going to be a repeated occurrence with such a popular stock being short squeezed and hedge funds losing so much money.
And with that, we hope this episode clarified any doubts and helped to explain the situation that occurred during this past week. And if you're more of a reader than a listener, be sure to check out our blog at Dogs of Wall Street on Medium, where we regularly post due diligence and equity analysis.
And make sure to follow our Instagram at Dollar Street Podcast. We post updates for our podcast episodes and our articles every week. Thank you.